Hello and welcome to the Broad Investors channel. This is Eminent speaking, and in this video we discuss why it's nearly doomsday for the Tesla stock. Now the key takeaway from this video should be that Tesla is not a disruptive company, but their share price reflects the opposite. So in this video, first we calculate the fair value of the company's stock. Second, we speculate on why their price is so high. Third, we discuss what their direct competitors are doing to catch up to Tesla. And finally, speak about whether the stock price can keep rising like it has been lately, and when we can anticipate the share price to drop, which seems pretty soon, hence the title of the video. Now, for a bit of background on Tesla, for those of you that think they're just an automotive company, Tesla does actually design, develop, manufacture and sells not only electric vehicles but also energy generation and storage systems internationally. Now the company operates in two segments, first being automotive as discussed, and energy generation and storage. Now the automotive segment has lately been booming by the production of the Model Y crossover vehicle and the hype of the opinion split in Tesla truck. Tesla also provides electric vehicle powertrain components and systems to other manufacturers. Now that we've got that out of the way, let's get into the crux of the video. The first aspect that we discussed earlier was fair value. Now, Tesla's current share price on Friday the 17th of July is $1,500. This is nearly 40 times more than the likes of Daimler, the parent company of Mercedes, at 39.34 euros. Tesla has a trailing 12 months P/E ratio of 364.28. Now this compared to the automotive industry is really high. The automotive industry has a average P/E ratio of 28.82. This figure of 364 for a PE ratio is obviously not sustainable. And as you can see from this next table from Nasdaq, their 2022 estimates is predicted to drop to 97.77 for Tesla. So let me show you how I calculated the fair value for Tesla. Okay guys, welcome to my infamous sheet. Most of you might have seen this sheet already. This is one of the tabs I use to calculate the fair value of a company, and I've already done this for Tesla for you guys. Now their current EPS normalized for this year is roughly $3.62, which is an eye-watering 414 times smaller than their current share price. Their annual growth rate for this year is estimated to be 35%, which is pretty good. And over a 10-year period, I've predicted at the end of that year their PE ratio will be roughly 65 for Tesla. I actually think this is very optimistic because by then the rest of the competition should catch up. And as said earlier, the automotive industry average PE ratio is around the 28 mark. So on the first year, the EPS normalized, or this year, is 3.62. Okay, and with a growth rate of 35% every year, the EPS normalized by the end of that 10-year period is going to be roughly around $54. And if we say at the end of that 10-year period the PE ratio is 65, okay, so it's 53.91 times 65, we get to roughly around $3,504 at the end of a 10-year period. Now if we go backwards by a minimum rate of return of 15%, okay, we get to roughly around the $996 per share mark for this stock. Okay, so their current share price of $1,500 is obviously inflated. Their books show us this with a relatively low EPS normalized. Okay, so the second point is speculating on their current share price. Now, why could it be so high? And this might explain why. This year, Tesla expects to deliver more than 500,000 cars. This is up by 36% from 2019. The China Gigafactory is ramping up production post the pandemic. They've had better than expected car delivery figures amidst the pandemic. And the market value of Tesla is now bigger than the likes of Toyota at 183.7 billion, making Tesla the world's most valuable automaker. Now all these factors have yielded a great surge in their stock price, but I think the most telling of all is that Tesla is treated like a technology company. And as you know from a previous video I've done on 5 key factors to consider before investing into the stock market. You might see it in the cards above. The tech stocks have been booming for the past couple of years at a stratospheric 36% growth rate in 2019 and possibly similar figures this year to 2019. In the race for pure electrification, the Tesla car currently can go further on a single charge compared to their competitors. I believe this has been their edge in the past few years, and lately with the likes of VW promising to dedicate tens of billions of euros by 2028 to electrify 70 new electrical models, they will soon be caught up by these companies. Now VW is one of the world's largest companies. They are 82 years old and have survived countless cycles of bust and boom. By 2022, Daimler will be bringing more than 10 different all-electric vehicles to market. Daimler will electrify their entire Mercedes-Benz portfolio, so their customers will have the choice of at least one electric alternative in every Mercedes-Benz model, taking a total to 50 overall. Okay. Now based out of China, Shenzhen, BYD, Build Your Dream, okay, is one of the world's fastest growing auto companies. Little known internationally, but BYD is already a giant in China. Its huge array of products touching on almost every high-tech sector from consumer electronics to energy storage. In fact, the company is already the world's largest producer of battery-powered vehicles. So Tesla, watch out. Okay. Now with all that said, I believe the market has made a mistake to think Tesla is a market disruptor. The company has a shouty frontman in Elon Musk and has taken a series of risks which actually have led to fatalities to electrify their fleet. This risk taken is why they are ahead at this current moment, which is good for Tesla. However, with every innovative car technology, this has been quickly adopted by their competitors, and with Tesla making their patents publicly available, it will not be long before their competitors catch up. Okay, their manufacturing process is overhyped. They use the same just-in-time manufacturing process that is used across the industry. And Tesla has sold powertrains and battery packs to their customers, which now means these companies can copy and reproduce those same single charge outputs. Now with all that said, we should all be thankful to Tesla for pushing the boundary and making giant slow-moving companies like VW and Daimler to wake up and rise up to the occasion. So this is the end of the video. If you like this video, please do like, share, subscribe. It really helps out the channel, and I'll see you in the next one.